Hey y'all, welcome here to week 5 of ACCT 2011, the reporting on business performance. Today, talking about leases. So, leases is a new idea, it's a little bit tricky. It's the idea that leases, financial leases specifically, record a lease liability and a lease asset. So, not only are leases expenses, but because we have a substantial right to the benefits of an asset, leases should also be recorded as an asset and as a lease liability. So a right of use asset and a lease liability. So there's a lot to talk about. 37 pages of lectures, and then I'm going to go through some Excel practice. So there's a lot. So let's just buckle in and let's get right into it. So let me minimize myself quite small because you don't really need to look at me. But all right, so reporting on business performance here in week 5. Week 5 notes here. We got reporting accounting for leases. So here's week 5 accounting for leases, and then there we go. And we're also going to go through some examples right here about accounting for leases and practical examples of what to debit and what to credit. So what is so here are the learning objectives. You can pause it and read it. So what is a lease? So leases are agreements that, in exchange for lease payments of one party, the right to possess and use an asset is given to another party. So if you lease a house, if you lease a property, if you use a unit, if you lease an aircraft, if you lease a phone, those are examples of potential leases. Now there are two types. There's financing leases and operational leases. Operational leases are less than 1 year and they are not recorded on your financial statements. Financial leases, however, are. So in all lease agreements, the lessee acquires the right to use the asset during the term of the lease, and the lessor continues to own the asset but does not have possession or right to use it. Now we can see a certain thing. So if you are the lessee and you get the right to use an asset, you get the benefits of the asset. You also get control over the asset. Now, what are the definitions of an asset? Benefit and control. So a lessee, if they have a substantially long-term lease, that could be considered an asset because it meets the definition of an asset, and therefore we need to record something called a lease liability and a lease asset. So lease agreement, here's an example of lease agreement. There has to be a specific asset involved, a specific period of time, and amount and frequency of payments to be made. So this is what makes a lease agreement what a lease agreement. So what are the implications of lease accounting for assessing operating performance? So there were two types of leases. For the purposes of going forward, when we talk about leases, we are always talking about financing leases. However, because finance leases are applied on balance sheet accounting. They are recorded as a right of use liability and a lease asset. Whereas operating leases are short-term leases that potentially that you do not need to record. This is, for example, if the CEO of a company goes to another city from Sydney to Melbourne, and during Melbourne he rents a car to travel around. That would usually not be considered a financing lease. That would be considered just a lease expense, rather than recording a lease liability and a lease asset. So when you record something as a finance lease, you increase your liabilities by a lot, making the book value look bad, making your assets look better, but also looking your book value look bad. So therefore, most preparers of financial statements will rather have leases recognized as operating leases instead of financing leases. So these are the two types of leases on entities' financial statements. Many lessees restricted their leases to ensure that they could be classified as operating leases. So we remember how I talked about if it is usually 12 months or more, it should be considered a finance lease. Some companies would have 11-month lease contracts, and that would be considered an operational lease with an unwritten agreement to continue that indefinitely or for a certain period of time. New approaches to lease accounting. So because there's a lot of controversy before 2018, ASB 16 came out with leases requiring on-balance sheet accounting for almost all leases going forward. So to explain prior to requirement of ASB 16 leases and to identify a lease. So a lease comes out of a contractual agreement. So we have to read a contract. We're going to go through an example here. Here we have an email that includes a contract, and we're going to read that and see if we could interpret it as a lease. So lease is a contract or part of a contract that conveys the right to use an asset, which is called the underlying asset, for a period of time in exchange for consideration. So consideration is rent. Underlying asset has to be specific. So an asset that is subject, specific means identifiable and explicit. All right, an asset that is subject of a lease for which the right to use the asset has been provided by a lessor to the lessee. So identify whether a contract contains a lease. So we have to look for certain things. So the first thing we have to look for is the asset explicitly and specifically identified. Second, we have to look if substantial economic benefits are transferred. For example, if I am leasing a store to you, then you get the storefront, so you get the substantial economic benefits. So you get the majority of economic benefits from the store when you are leasing. Then you got direct use of the asset. You are not leasing to someone who is leasing it to someone else. You are leasing it to the end customer, so direct use of the asset. So these three things have to be looked for when you're reading through a contract or part of a contract to determine whether or not it meets the requirements of having a lease. Identify whether a contract contains a lease. So here's an example here. Right to use. So it has to be substantial, which is not given. It's not like 50-60%. It's substantial, so it's up to the interpretations of the preparers of financial statements to see how much substantial is. Identify when a contract contains a lease. So just remember these three things. The asset has to be explicitly identified, has to be substantial economic benefit used, and there has to be direct use of the asset. So these three things are the keys to seeing whether or not there is a lease within a contract. Then we have to require see how leases are applied and explain and apply the requirements of leases on the leasee. So accounting for leases by the leasee. So from the leaser side, it's very easy. You just you give the leasee the asset, and in exchange you get periodic payments. From the leasee's payment, it's a little complicated because you have to record two things. You have to record lease liability and right to use assets. So at the commencement date of each lease, calculate the amount of initial measurement. So you have to do lease liability, which is a discounted of future rent payments, and a right to use asset, which is the lease liability plus certain other items. So accounting for leases by the leasee. So here we have the lease liability calculation, which is the net present value, which is the discounted future value of fixed payments not paid at commencement date at less than the lease incentive received. So if you get incentives, for example, cash incentives, then you subtract that out. Plus the present value of variable payments not covered. This is not covered in ACCT 2011. Variable payments could be very tricky and hard to estimate and takes a lot of professional judgment. Also, the present value of expected guaranteed residual value. And the present value of terminated penalties if reasonably expected to be break the lease early, and exercise price of purchase option if the leasee expects to exercise that option. And right to use asset adds this in addition to these certain items. So this is how lease liabilities are calculated. We're going to go through an example here very shortly, but before we do that, let's just keep going. Accounting for lease by the leasee. So interest rates, you have to use an interest rate that discounts future rent payments or future expected payments back to the present time. Expected guarantee residual value, also discounted to the current time. Accounting for lease by the leasee initial measurement. So here's just an example. You could pause the video and you could read that. Example, account for leasing by the leasee. So this is what you debit and credit. When you increase right of use asset, you debit right of use asset, and you credit lease liability and cash at bank. So cash at bank decreases and lease liability increases. This is how you record it. And then to recognize right of use asset, lease liability, and initial payments, you debit right of use asset, credit cash. So cash decreases, and that goes to the right of use asset. This is how you record them. And accounting for lease for leasee subsequent measures to right to use asset, provisions and ethics is next. So let's look at an example here. So the background here is that Hunter Hospitality is a business that operates bars and hospitals, hotels across regional New South Wales, and is planning to expand its operations to the greater Sydney metropolitan area. The first phase of its plans to open a bar in Parramatta, focusing on serving craft beers. Hunter has identified the bottom floor of a multi-story building in Parramatta along a busy Drew face as the ideal location for the bar. Which we named the Blue Badger, the BB. So we have to go through this email to identify if there's a contract. So this is the first part here, to identify if there's a contract, and then we're going to do the journal entry. So let's read this email here. So hi Robin, this is from the property owners to I believe to Hunter. So Hunter is the company that's renting, and SLC is SLC, SCP Property is the landlord. So hi Robin, we are currently working on BB Premises contract. Before the contract is presented to the board for approval, we need to know if lease arrangement will be identified in the contract. So you can read this yourself. Please pause the video and read this email. Okay, so let's go through the to see whether or not this exists as a valid lease asset and lease liability. So is the contract for an explicitly identified asset? Consider whether the supplier has substantial right to substitute the asset. So yes, they do. If you have read it, it is for a specific asset for the bottom floor of this building in Parramatta, and there is no substantial ability to substitute the asset. So therefore, yes. And here's the discussion written for the explanation. Does the supplier have a substantial right to substitute the asset? No. If you read the email, you would know. So does the right to substantially all of the assets future economic benefit? Yes, Hunter has the right of substantially economic benefit associated with BB's premises. Substantial all of economic benefit associated with the property is enjoyed by BB since BB has operational rights to use the premises. Does Hunter have the right to direct? Yes, they have the right to see how it is fitted. Lastly, does the requirement to install furniture, appliances, and decorations in compliance with regulatory regulations negate the right to direct use? No, it does not. The requirements that Hunter installs bar furniture does not. Therefore, it is concluded that Hunter has the right to control. Therefore, in conclusion, the contract specifies as identified assets that BB premises. The customer has the right to control the use of the identified assets. Therefore, the contract contains a lease. So if you read this, you will know that the contract contains a lease. Now, we are going to do some journal entries. So first of all, what is the annual lease payment? If we look at the annual lease payment is of $140,000 per year. So $140,000 per year. Present value factor is that. So we are using annuity. So we are using 4%. Once again, we are using 4% because this here, if you have read the email, it says the interest rate implicit in the contract is 4%. So using a 4% discount rate over 2 years. So this is what we are using. Multiply these two, we get the present value of lease payments. So renewal lease payments at 2026 is $180,000. If you read the contract here, it is $180,000 at renewal at 2026. At the present value factor, discounted of 0.889 for 3 years, then it is the present value of that. So lease liability is simply the sum of these two. Then we have right of use asset. The lease liability is simply the lease liability, which is the sum of present value of lease payments plus the present value of renewal lease payments. Initial lease payment is $80,000 here, as you can see from point 2. So it is $80,000 here. Here we have the fit out costs. If you read the email, you will see how this makes a lot of sense, and that's how we calculate the interest and the depreciation. Here are the journal entries, and here are the things that you should make. So you can pause the video, you can look at this, and I think it's pretty straightforward. Also, remember these debits and credits are the exact same as the debits and credits as talked about here. So we debit right of use asset, credit lease liability, and cash in bank. We debit right of use asset, credit lease liability, and cash in bank. So this is just an application of using the case here in this example. All right, so I do hope, once again, that this video is helpful and that you took away something. Once again, I'm trying to detailedly include everything that I learned in university, week by week, class by class, and this is just week 5's content for ACCT 2011. So thank you for coming along. Good luck studying. Take care and goodbye.